I don't know if Michael Anthony is going to be watching the live stream today, or if maybe he'll pick it up a little bit later once it's been recorded. But a name that he has brought up in the chat before is Pfizer. I happened to mention Pfizer on Fast Money yesterday, and we already have a question about it. So that's at least one of the things that we're going to talk about today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. So as I just pointed out yesterday, we had a conversation about Pfizer. Now, I will tell you from the very beginning that Pfizer is just not one of the names that I have been hugely enamored of for some time. One of our regular viewers, Michael Anthony, has asked questions about it from time to time. Let me talk first about why I haven't historically liked it very much. I think many of you who watch regularly will already know the answer to this, but I have sort of a philosophy about investing in stocks, and that is that I'm not that terribly interested in stocks that do not exhibit characteristics that the market itself has. So what are those characteristics? If you're investing in equities, commonly what you're looking for is capital appreciation over time. And S&P revenues tend to grow at a fairly attractive rate. S&P earnings tend to grow at a fairly attractive rate. The S&P is highly diversified. And consequently, it's an attractive investment in its own right. To begin to look at single stocks, usually they have to exhibit some characteristic that makes them superior to the market more generally. And Pfizer hasn't historically done that. Let me give you some examples of what I'm talking about. So looking first at the just the growth of sales over the course of time. So we'll put revenues in here. I think this should give me that. So now I've got, that's for the S&P. I'm going to get rid of price to earnings. I'm going to get rid of price because I don't really want to focus on that for the moment. So here we have the growth in sales for the S&P, and hopefully this will graph on a separate axis. And this is the growth in sales or revenues for Pfizer. So in one case you can see it's fairly measured and orderly. Compound annual growth rate over the course of the last 10 years for S&P revenue growth is 5.85%. With a couple drawdowns, but you can see that those drawdowns are not hugely pronounced. On the other hand, the 10-year compound annual growth rate for revenues in Pfizer is essentially flat, up 0.45%. It had this huge spike in here. That huge spike, of course, being associated with the fact that Pfizer was one of the principal manufacturers of COVID vaccines. AstraZeneca being another, and Moderna being another. So the top line, not a brilliant story. So then we can move on to earnings. So we'll just include basic earnings per share. I think this is probably a fine way to think about it, so we'll throw that in. And maybe I'll just get rid of revenue. Well, you can sort of see that these things track one another. But if we take a look on the earnings per share side, this was typically going to be better for the broad market. And sure enough, we can see that the compound annual growth rate for earnings per share for the S&P over the course of the last 10 years, 8.4% now. So we've talked about this before, that earnings have historically grown faster even than top line, particularly of late, as we've seen more asset-light businesses and astronomically high profit margins from companies like NVDA, which tend to make up a disproportionate part of the S&P numbers. Compare that instead to the compound annual growth rate of EPS for Pfizer, and it's 0. So under normal circumstances, I would just say, okay, I'm not interested in this one. And some people have brought this up on the channel on more than one occasion in the past. Why did they bring it up? Well, the reason they brought it up is because a lot of people screen stocks. And one of the things that they like to screen on is price to earnings. Now, if you look at it on a price to earnings basis, it's a very different picture. Or maybe they look at it on a dividend basis. So let's actually talk about the dividends first. Pfizer pays a very handsome dividend, over 6% per year. And on top of all of that, it is well covered. We can see that by the free cash flow numbers. Those are the numbers down here. Maybe I can make those a little bit larger. So I'm going to scroll down here. If you can see the line that I'm highlighting, you can't see my cursor, but the line that I'm highlighting down here, that's the free cash flow. And if we take a look at the free cash flow relative to the enterprise value, which thinks about the value of the business net of cash or debt, you can see that the full year estimated free cash flow of $14.7 billion on an enterprise value of, we'll just call it in round numbers, 203.5. So that's a 7.2% free cash flow yield. We can take a look at the anticipated free cash flow growth. So that's going to be the 15,691 or so millions that they're anticipated to have next year over the 14,715 that they have this year. So that's 6.6% year-on-year free cash flow growth, and that is net of the anticipated dividends, by the way, right? So that free cash flow is after making dividend distributions. Very modest EPS growth is forecast, so that hasn't gotten a whole lot more exciting. So why did I happen to mention this yesterday? You know, and also it's trading at a single-digit multiple, so it's a little bit higher now because the stock has spiked. It spiked yesterday. It spiked again today, and that might mean that we are interested in doing a trade, but we would hold off. But you know, versus next year's earnings, it's trading about 8.6 times next year's earnings, so it's trading quite cheap, at least on a PE basis. The issue that is becoming interesting about it is something a little bit different, which is that they did a deal with the administration. One of the things that has been affecting a lot of companies and have a lot of people concerned, of course, is tariffs. Pharmaceuticals are also manufactured overseas. On top of all of that, they're kind of a political hot potato, because it's well known that in many cases, some of the major drug manufacturers of the world don't necessarily charge the same price for critical drugs in the United States that they charge in other places. Essentially, what the Trump administration has done is they have reached an agreement whereby Pfizer is going to discount some critical drugs that are purchased by government healthcare plans, so that they are not going to be paying more than they might pay for the same drug in other countries. That seems like a fair thing. I'm sure taxpayers would be rather disenchanted with the notion that U.S. taxpayers would pay a U.S. drug company more money to buy drugs than they can be purchased for elsewhere. So that's a positive. The other is that they're going to get a tariff exemption. And this is quite important, because this was one of the reasons that the company was trading as cheap as it was because this overhang existed. Now, my guess is that the administration is not only negotiating with Pfizer. I will also add that on its own, I don't necessarily think that that corrects every other issue that Pfizer has. Drug companies have to deal with pipelines, and they have drugs that will be coming off patent, and then you hope that you can replace those with new drugs, which obviously the patented ones have considerably better margins. So when you put all of those things together, do I think it's hugely exciting? Not hugely exciting, but I did suggest that I thought that it would be a reasonable place to make a potential bet that it could continue a little bit higher on the back of this news, in part for another reason, and that is that drug companies like this one don't tend to trade with very high implied volatilities, such is the case for Pfizer. This thing has been trading, well, now it's actually popped up as I speak to you now, but when I had been looking at it, I'd actually been seeing it from a couple days ago. The implied volatility was less than 25% going out 3 months. You add to that the fact that the stock pays this huge dividend, and generally speaking, that reduces the cost of upside calls. So let's take a look at that just to see how that plays out. So here we are. We're looking at Pfizer. Why don't we just take a look at the calls first? Now, one of the things you're going to notice, this is an important consideration. If you own the stock, you get that dividend, and it's a big dividend. If you own the options, you do not get the dividend. So when you're looking at the price of options, pay attention to when the ex-dividend dates are, because that is going to, so if you're making mostly just a bet on the future direction of the stock, if you're looking at calls that actually capture a couple dividends, their prices are going to seem even lower, and that's because on the ex-dividend date, the stock will trade down by the ex-dividend amount. If you own the shares, you'll get the dividend, so the decline in the stock price, it's a push, it's a wash for you. Not true if you own the call, because the call is only based on the stock price. You don't get the dividend unless you exercise that call ahead of the dividend, something you would only do if, number one, that call is in the money, and number two, it is in the money by enough that the extrinsic value of the call is less than the net present value of the relevant dividends you would receive by exercising that you otherwise would not by not doing so. Okay. So having gotten that out of the way, why don't we just take a quick peek at the dividend schedule so that we know when we're looking at the expirations of the respective options where we're going to sort of see these lower options prices. Okay, so these are the past ones, these are the future ones. So we have pretty much any option in November or on, that's going to capture the next one, which is 43 cents, because it's going to go X on the 7th. January options, by the looks of things, I think January expiration is before the 23rd. We'll confirm that almost certainly. But so that one will not incorporate it, and so on. So let's just take a quick peek now. And, oh, you know, one other thing we should probably do before we go over here, this is also worthwhile. Let's also make sure to take a look at the term structure of volatility. Just see whether there's anything that sticks out. You know, looks notable in terms of on the long end here. Now we can see this is a little bit uncommon, right? Because usually what happens when news comes out, that means the catalyst is now behind you. If the stock responds favorably, very often volatility will drop. That's not exactly what happened here. In fact, quite the opposite. We can see that implied volatility is now actually a little bit higher. So this trade isn't quite as attractive as it was yesterday, and in turn it was not quite as attractive yesterday as it was the day prior, but let's sort of work through a potential structure, and then we can talk a little bit about how and when and if we're going to time the entry to such a trade. Okay. So January expiration, let me just double check this. That's the 16th, so that will not capture that second dividend. It will capture the one in November, of course. So that is going to be decremented then, because the net present value, the forward price of the stock, is going to take in the net present value of that anticipated dividend. So that's going to reduce the price of that call and increase the value of the corresponding put to account for that. Otherwise, there would be an arbitrage. So, and as we can see, with the stock right now trading very close to 27.5, the 27.5 call, I'll go full screen. Here we go. Is $1.44. We'll call it $1.45. Makes the math relatively easy. So this is this is a trade that one could use just to press a bullish bet, which might be tempting because the stock has actually gotten quite a pop. It was up, I think, better than 6% yesterday. It's up more than 6% again today. So that's actually quite a sharp move. Oh yeah, one final. Sorry, don't mean to bop back and forth, but there is one other thing that's, I think, important here. I did not consult Carter Worth on this. He has not sent me anything on it. But I will tell you that one of the other things I like to look at is, okay, we have a weak stock. It's been in a prolonged downtrend. Have we gotten any evidence that it is now out of that downtrend? So it had been bouncing along the 150 here. We can see this is the downtrend we were in. Been bouncing along. We had this sort of failed reversal here, but now it looks like it has kind of definitively gone above the 150. If we made that, and all these things are kind of an automated just trend line. So maybe we'll look at the 200 also. You can see it's definitively through that as well. You can pick your poison in terms of how you want to draw the trend line. We could draw them another way if we wanted. We could just draw a straight line, and I'll do that. So maybe I'll take this, and we'll go over here, Actually, we have that big sort of pop in there. But in any case, if you drew some sort of a channel, anything like this, it does appear that it has kind of bottomed out here a little bit. All right. And, one other thing. Look, it's sharply off the lows. But when you're dealing with a stock that's trading 6 or 7 times earnings, you can have a 10% move. And that takes a stock from, 6.5 earnings to 7. It's not hugely meaningful. Actually, this brings up another thing, which maybe someone can get my ear and remind me. It has to do with a comment that was also made on Fast Money yesterday by people being excessively or over loyal to stocks that they hold or that they like. I actually want to opine on that because I think there's something else that might be going on there that they didn't consider. But okay. So this is a trade that I would be inclined to go out, a little bit of time. But because there has been a bit of a pop and vol, probably try to sell something against it. Look at this downside as a little bit of a backstop. Bear in mind as well that because this is going to elevate, those dividends tend to elevate the price of those puts just a little bit. We can, try to do something like a call spread risk reversal, something along those lines. Try to get the cost. Let's go like this. So we'll go up here, maybe sell a, on the call side, oops, those are both puts. There's the problem. So maybe we can pick something like a 31 or something like that. And then we can also, we know that the stock was, in and around this level here. What are we looking at? About $23.5, $24. This is still going to have a net outlay, but something like that. This is the kind of trade that I think might make some sense if you're inclined to, push for a little bit of additional upside here, right? Normally, I probably wouldn't do a sale of both wings, but as I just illustrated, implied volatility, which is usually very low, it's a little higher than usual. And then you can sort of pick your poison and tweak things a little bit this way or that. All right. So here's something else to think about. I'm trying to remember what his name was. There was a guest on Fast yesterday, and let me see if Caleb Silver. Caleb Silver was his name. He works, I think he works for Investopedia. I don't know Caleb. Never met the guy, never spoken to him in person. For anybody who is interested, I think his X handle is at Caleb Silver, so if you're interested in following him. But he was talking about something called the Investopedia survey. And what he was talking about was, and this is, I think, a direct quote, one of the things I want to highlight this round is the fact that individual investors are over loyal to their favorite stocks, even though they think they are in a bubble and missing out on owning the best performing stocks in the market below. Okay. This concept of being overly loyal, I wanted to get into this conversation on Fast Money yesterday. I'm remote. Everybody else is on the desk, so I can't just intrude and hold my hand up and say, hey, let me in. I got something to say. But I did have something to say about it, and one of the reasons I had something to say about it is because I happen to know somebody who has a relatively concentrated position in a stock that has done exceptionally well. This person that I know has many, many millions of dollars in Netflix, has a cost basis of about $200 a share, and lives here in California. Now, is this person overly loyal to Netflix? Well, here's the thing you have to think about. So if you have a basis of $200 in a stock, let's just work through this. I'm just going to show you what's going on here so you can kind of see it. So let's take a look first at Netflix chart over the course of the last 5 years. And this is going to give us a sense of, where we've come from. All right. So here we are, right in here. Stock was about 200. Now it's about 1,200. We're going to just use this to keep the math easy. So here you have an appreciated equity position. Let's just say a $10 million position. This also helps keep the math easy, as it turns out. So a $10 million position with a basis of $200 a share, effectively appreciation, long-term capital gains of $1,000 a share. All right. Now, this is a person that I have spoken to about that position, about potential hedges to it. Not much interest in hedging it. Wonders a little bit about the valuation now, but isn't going to sell it. Why? Well, here's the problem. Okay? First, let's just talk about the tax implications. $1,000 worth of capital gains in that tax bracket is a 20% federal long-term capital gains tax hit and another hit of 13.3% plus in California. All right? So, round numbers, we're looking at $330 a share in taxes if you sold this appreciated position, assuming that you're in that tax bracket and you own it off of those 2022 lows. Well, another way to think about that is, okay, well, you don't want to pay taxes, but if you did pay the taxes, what is the valuation you're selling the stock for? And the answer is, it is the net tax amount divided by the future anticipated earnings, which, as we can see here, is about $32.50 a share. All right. So $1,200 a share. I said I wanted to keep the math easy. So even though it's $1,170, but let's just call it $1,200 less $330 in taxes is $870 a share divided by 32.50. That means that if you sold the stock, net of the taxes you pay, in that example, you're selling the stock at 26.7 times forward earnings, which is about where the market is trading, except that this thing is growing the top line at 13%. It's growing the bottom line at 22%. So why would you do that? You would not do that. It is not a question about loyalty. I mean, no disrespect to Caleb Silver. And, I think people ignore this, that the reality of people being locked into positions is kind of like people having a house with a really low mortgage rate. You can't replicate that mortgage. So in other words, he can't get the same deal. Now, here's the irony, right? So just to give you a sense of how big a spread that is, how big an impact the taxes are in this case. At the current stock price, again, I'm going to use 1,200 because I said I was keeping the math easy. It's 37 times earnings. So his choices are, he can own it at 37 times earnings, or he can sell it at 27 times earnings, or less, actually, 26.5. Once you sort of work through it this way, one begins to understand how money gets locked up in these shares. It's also probably one of the reasons why the vol can get quite high, because what will happen is, minor moves in the market and people are not overly compelled to try to do something quickly about their positions. Only once full panic sets in are they going to say, you know what, to hell with it. I'll face the music on the tax side. And I think that has a lot to do with it. And you're going to see a lot of that kind of thing going on in the most highly appreciated stocks. And by the way, high tax locations like New York and California have also a disproportionate number of really high net worth individuals who probably hold concentrated positions in these stocks. And by the way, it is those very same concentrated positions which are not the ones that are going to be in tax-deferred accounts. So you're not looking at self-directed Roth IRAs and 401ks and things like that. What you're looking at are people that, like this acquaintance of mine, has 8 figures in just one of his holdings. And he, it's a 5-bagger. And would he buy this much of it here? No, but he doesn't want to sell it 10 turns cheaper, which is where you actually get out. That's how big the bid-ask spread is when you start accounting for those kinds of slippages. So I think that helps account. And by the way, this is something to think about too when you start to see the market roll over, if it does, at some point. Some of those might be those kinds of flows, right? People who are kind of locked up, and then you have this next situation. Okay, so We sort of touched on the Pfizer thing. We talked about the locked up issue. Let's move on. Steve Garcia, what do you got for us? I just put on an Amazon put collar spread for the Oct 25th expiration, short the 235 calls, long the 215 puts, and short the 195 puts. I'm assuming this is for against a long because you're referring to it as a collar. This would be, we would consider this a form of a risk reversal or something like that if it was not against stock. But okay, so you have a put spread collar on the stock for an 88-cent debit, which is, let's be honest, an 88-cent debit on a $20 put spread collar, because that's the distance between the strikes. 235 to 215 is 20, 215 to 195, another 20. 88 cents share over 20 is basically, we'll call it even money. So let's examine this trade. We're going to put it together. And what did I do with my options play application? Here we go. I like Amazon, by the way. Stock is in every... there was an old commercial. Visa, it's everywhere you want to be. Yeah, so is Amazon. They're doing a lot of things right. It's hard to see which businesses they don't touch in a positive way. And it's not expensive. So we'll get to that in just a minute. And their free cash flow is shooting up, which is good. But I can understand why after the kind of rally we've seen. So we're going to go, this thing's got like this, modify this. You are long the stock. Just put some mid-market prices. We're going to add a call. We're going to add 2 puts, as you have done. You sold a call. You bought a put. You sold a put. And in your case, it was the 235. Oops, I'm in November. Okay, 235, 215, 195. And voila. So did I get that right? I think I did. Short the 235s, long the 215, short the 195s for an 88-cent debit. Okay, let me get rid of the stock here for a second. So, all right. Well, you're already up money. Not a lot of it, but 50 cents maybe. This is your trade. So basically from here, this is the way to think about it, which is basically how can this position do from here till there. So you're going to be capped out up at this level, which also happens to be just under the highs. What were the highs? So 242.5. So basically you have exposure for most of the way back to the all-time highs here. And then you're going to mute your downside exposure. So I like the trade, but should I have gone further out like November? I don't think that would be I don't think it's a bad move. 23 days, the thing about really short options like this is that you end up with a lot of gamma. And that's okay if you're only looking out. But let's just say we went to November regular way. The trade's going to look a little bit more like this. The other thing, though, that if you go further out in time, you might also want to think about going a little bit further out in terms of strikes as well, right? So you might do something that looks a little bit more like, well, the 195s are probably not a bad selection. I might bump, if I went further out, I'd probably bump that upside call out a little bit too. But you're going to get more of a vol crush, and you're going to have less gamma. You see, and if you see this curve here, let me blow this up. So this curve, you're going to notice sort of how gradual and smooth it is. That curve instantaneously converges to that step P&L graph that you see as expiration approaches. So the value of your position is just going to be a lot smoother and easier to manage if it's a little bit longer dated as this one is. And we can illustrate that pretty easily by just backing up the clock. So I'm going to go back to the OCT25s. Watch what's happening. All right. So now you can see that that curve is adhering more closely now to that sort of step function behavior. And the thing about that step function behavior is that you actually, the closer you get to that, the greater the losses you would experience on a near downside move right here, right? So if the objective is to say, you know what, I like the position, I want to smooth out my results, I want a little bit of push from a vol crush, then the longer dated position is probably going to make some sense. Now, we should also look at one other thing, and that is how much vol crush we, when are they reporting? Let me double check that. So we should probably see that first. End of the month. Okay, so that's the other thing. Oh, you must have meant that you had the October month ending? Yeah, I guess. Yeah, probably. Because you weren't going to be capturing that earnings with the OCT25s anyway, because we can see that. I don't know if I'm going to have a vol crush for this one yet, because it's a little bit far down the road here. Okay, so we get a, looks like the after, something in the neighborhood, a high of 35 or 36, low of 24, okay? Let's see where that is right now. November is what we're looking at. So November's at the money implied volatility is 34, it's about 36. So, you know, you're probably going to get at least, you know, you're going to get at least 10 clicks of vol out of this thing. Now, you're getting 10 clicks of vol out of it after earnings, so that's still a ways off. But, yeah, and what's going to happen is the implied volatility of those options is going to probably rise before it falls. So a lot of the push that you're going to get is going to happen. So the benefit in the near term is not going to be because you have those two short wings. The benefit in the near term is going to be because you're going to mute the deltas that you have. Only after the catalyst has come and gone can you expect to get that vol crush benefit. You know, and which, you know, brings up another interesting point, which is that, you know, one doesn't have to sell the two options and could just go for a straight collar and then look to work into a put spread collar a little bit later. That's another way to kind of approach it. Okay. Let's see here. Pfizer, Steve says, it's not a bad stock to simply own. One gets a really nice dividend that's covered call with their free cash flow. Yeah, I think that's also true, right? It's, you know, this is not a proxy for owning equities. You know, it's a little bit of a kicker, you know, relative to a fixed income instrument is the way I would probably think about it. Because, you know, between the dividend and everything else and just the fact that it doesn't have really great growth, yeah, don't think of it that way. But it is, you know, it has an attractive yield. And that's probably the way I would think about companies like this. It has a reasonably attractive yield. It's just gotten rid of a potential headwind with the tariff thing. So, yeah. James, Mr. Mike, SPY is scary high. I don't want to go long into November. Until I get your feeling about SPY performance in October. I don't have a crystal ball. Sure wish I did. That would be very, very handy for all kinds of things. You know, seasonally, I'm not terribly concerned. You know, I'm with you, as I'm sure I'm with most of you, in that, and that other chart that I had up, it's not the absolute price of the S&P that troubles me. It is the multiple, right? And it's not the multiple alone that troubles me. It's the multiple in the context of other things going on. So what are some of those other things that are going on? Yesterday, was it yesterday? Might have been the day before. I may be blending these two things together. And we're going to find out more about this because financials are going to be amongst the first to report. You know, we're going to get JP Morgan and so on. But, you know, a lot of the BNPLs got hit yesterday. I'm sure a lot of you observed that. Capital One got hit yesterday. American Express got hit yesterday. That came as a little bit of a surprise to me because I think of them skewing towards a more affluent demographic. And some of the things that came up. So someone published a report that said that the average household anticipated holiday gift spending was about $100, $130 less year over year for this coming year. There was some back and forth on the desk yesterday as folks were discussing this and whether or not that was going to have an implication for more affluent consumers. My sense of it was no, that it was not going to. That the most affluent consumers were not going to be affected by concerns about a potentially weakening job market, and they don't have issues associated with exhausted credit. I think maybe it was CarMax or one of the others that said that the delinquency rates on auto loans, 90 days plus, was the highest in somewhere between 14 and 17 years. Again, I'm just going off of memory. There's a lot to absorb this week. All of it's speaking to a fairly weak consumer. My guess is that the most affluent consumers are not going to curb their spending. Not with the stock market here. The wealth effect is just too profound. And I don't think that consumer base is going to be impacted by worries the way that some of the others will be. So all of the BNPLs got hard hit. Capital One, which skews maybe towards the lower end of the demographic, that got hit. MasterCard and Visa, incidentally, very curiously, were both higher yesterday, and American Express was lower, and that's not what I would have expected. I have made maybe part of that is because American Express has rallied a bit recently, but I've made two comments. I think one of them on American Express was a week or two ago, whenever it was that they announced the price hike for their Platinum card and also the associated benefits that come with membership if you happen to have one of those. I'm trying to remember. I think the new price annually is something like $8.95, but it is one of the first years that if you add up the value of the benefits you receive for having one, it's a positive number. So, for example, you get like a $400 Resi credit and some other stuff like that. And I thought that was a positive for American Express. But, yes, I'm kind of with you. When you look at this chart, you say, okay, well, here we are, 25-ish, whatever, times forward. So I'll just draw a line in here. What other times were we at a similar valuation? Can I make it stay put? Yeah, that's close enough, whatever. Okay, so 98, 99, that region. I can throw this out because the pandemic, we just saw a big plunge in earnings because the economy was shut down. So going to this other piece, is this working? Yes, there we go. And let's do this. So let's look at this section then, right here. So this is the period that goes into the tech bubble. So you look at that and you say, well, that's fairly ominous. But I would like you to observe something else about that, and that is, number one, the tech bubble peak was still, considerably higher than we are right now. But the other thing I would ask you to keep your eye on is notice how long this period was, right? So right here where my cursor is, if you can see my cursor, I'm not sure, it's a little pinkish thing. Maybe you can't see it. Maybe I can draw on this a different way. I probably can. Let's do that. Let's see if I can. Oh, it was small. Okay. So this period right here is years. This is a 2-year window, right? From all of 98, all of 99, into March of 2000. That's when it ultimately topped out and rolled over. So just because we're bumping up against that does not mean that we can't linger here for a little bit longer, or even for a lot longer. That's certainly a possibility. We'll go back to Carter Worth's earlier point, which is that we had a significant pullback in the liberation tariff tantrum era early this year. Stacking those things together is somewhat uncommon. So, and right now, earnings are still pretty good. So, while I am very concerned about this, my suspicion is that we're probably going to make it through the end of the year, barring something really jarring from a geopolitical standpoint, or some really crushing and surprising earnings disappointments once they start to report. That if I was long stocks, thinking about selling them, and I didn't have a tax consequence, right? Because that's the other thing, right? Remember what I was saying, that if you own stocks here, but net of taxes, you end up selling them here. Not maybe as bad as that Netflix example. That is a problem, right? So you don't want to incur taxes, because then you're guaranteed that you're going to take a loss. You're going to pay those taxes, and then it's out the door. So if your question to me is, do I sell here? It has to drop a lot to make that worthwhile, particularly if you live in a high tax jurisdiction. So I'll clear all this stuff, and we will move on from that conversation. Okay, but I'm with you. I mean, it's difficult. Alex V, Micron gained 8.5%. I have the 162.580 call spread. Should I roll those or just straight close them and wait through Oct? Well, oops. Let me get rid of this annotation thing. Let's take a peek. Oops. Where'd my... oh, here we are. So let's take a look. So with respect to rolling, did you mention what expert? Yeah, you said Oct. Okay, so we'll do that. And we're going to modify this. Or no, we're going to modify this one because it's already a call spread. Oct regulars, I assume you mean? Because you don't specify otherwise. So the 162.5s. And the 180s. There we go. All right. So here's what you've got. You're essentially short a put spread now. Synthetically, that's the way I would think about it. You have a standstill rate of return, meaning that if you just sit tight, this thing will appreciate. But you have an asymmetric risk reward, and I'm guessing that you didn't put this on to have that situation. So my short version, my short answer to you is yes, I would roll. I have said this a couple of times before, but generally on the long option side, once you start doubling your delta, so if you buy a 30 delta call, for example, and now it's, in this case, it's well above that. It's 87. It's almost stock now. You probably want to think about rolling it. And I might consider rolling it up and out. Okay. Monday morning quarterback, bought Pfizer and Jan 29 calls. Texas spread at the open, like the price to earnings, div yield, and low correlation. Okay, so that was well timed. You got to benefit from this news. Lori Peck, I noticed NVIDIA had an option $7 in the money, and Pfizer option was only $2 in the money, and the profit was similar. Is that because of the lower volatility and volume or other factors? Curious. Newer at this. I noticed NVIDIA had an option $7 in the money, and Pfizer option that was only $2 in the money, and the profit was similar. I'm not. Probably we need a little bit more color on which options you are talking about so that I can be sure that I know what you're referring to. Let's just talk about a couple other things, though. So first of all, volume. The options volume by itself is not going to have any implication on the profitability of an options structure, all else equal, right? So there are options that trade a lot. There are options that don't trade that much. What matters is the implied volatility. Implied volatility is an options trader's way of thinking about the price of an option. And also the price of the options relative to how much the underlying stock is moving around. So the two volatilities, if you're thinking about vol, if you see someone say vol of vol, or they talk about this vol and that vol, the vol they're probably not talking about when they're talking about options is volume, either of the stock or the options themselves, unless there's something really unusual. You know, you have an upcoming catalyst and all of a sudden you see some huge options trade that's really strange. And you think, does somebody know something? You know? Sometimes it's worth paying attention to those kinds of things, but you know, I don't necessarily advocate that as a strategy, but you should keep your eyes open for it. So it's the implied volatility that's going to matter, and the implied volatility of these two stocks is going to be pretty different. How different? Well, let's pull it up side by side and see how these differ. So I'm going to take a look at NVIDIA's volatility here. And we'll just take a look at the price of at-the-money 3-month options, and we're going to look at Pfizer down here and do the exact same. Okay, so this is not thinking about price at all. All we're doing at this point is saying, okay, what do the price of options on these two stocks look like relative to one another? And as you can see, the implied volatility, so this is, you know, takes price out of the equation, everything else. All we're looking at is how much is an at-the-money 3-month call or put option in NVIDIA relative to a similar moneyness option and similar tenor, that is days to maturity, or exactly the same in this case, in Pfizer. And you can see that the difference is big, right? What's interesting here is that you can see that the difference is not anywhere near as big as it was. This is where that spread used to be. This is where that spread is now. How much, you know, how low can it go? In other words, can NVIDIA's volatility fall down to Pfizer's level? I don't think so. The reason I don't think so is because NVIDIA is a very different company than a slow or not growing pharmaceutical company that pays a big fat dividend. It doesn't pay any dividend. It's in a much more speculative business. It's growing far faster. There's a lot more interest in it. So, yeah, if you are, you know, you're probably not going to get a whole lot by comparing the value of options on NVIDIA to the prices of options on Pfizer. But, yeah. Okay. So, oops, let's see here. Monday morning quarterback. There's also a net investment income tax in addition, another 3.8%. Yeah, that's the thing, right? So you can actually end up with a federal tax, and then you add up all the rest of it. It can be more than 35%. Pretty ugly. And Steve Garcia, yes, I'm long. Okay, so, oh yeah, and you know what? Just on the Amazon front. You know, when I was saying I don't happen to think it's overly expensive. Why do I not think it's overly expensive? Here's the reason I don't think it's overly expensive. Because when I take a look at the earnings multiples, right? So next year we're looking at $9 a share. We'll call it 9.10. That's 24 times earnings, which is less than the forward turn on the S&P. Remember what the compound annual growth rate was for the S&P that we were looking at earlier, 5.85. What was the compound annual growth rate for earnings? You know, 8.5%. Here we're looking at 10 and almost 10. Good free cash flow growth, probably faster than the S&P generally, and touching all the critical businesses and trading 2 turns cheaper than the market. So that was how I got there. It should trade maybe a little bit cheaper, but you know, I think this is it's kind of a good place to be. The only thing I worry about with companies like this is, you know, that some of the really big companies, I get concerned that they somehow land in the political crosshairs. And, that was a problem with Alphabet. Now they managed to skirt the threat that they were going to have to divest Chrome, which obviously helped the stock. But you get a little bit concerned. The hyperscalers, there's just a handful of businesses that are controlling basically the whole industry. Amazon is, an 800-pound gorilla. And, normally I would say if you had a Republican administration and control of Washington, it wouldn't be so much of an issue. But people should remember that, there was a big trust-busting effort in Roosevelt's time, and I'm not talking about FDR. I'm talking about Teddy. And so, you can have, you can have enemies in Washington regardless of your political alignment. And, these behemoths, it is a risk. It's not a huge risk, I don't think. But it is one of the things I think about. That's not a risk that the S&P overall faces. So that's the only downside. But, look, 24 times growing at 10%. Good free cash flow growth. That's a very reasonable and diversified business. So, I'm fine with it, other than the concerns I just expressed. Lori Peck is asking, our MasterCard. Oh, oops, sorry. Hi, Mike. 2 shitty companies. Well, we're not on CNBC, so I guess we can say that, right? But I think they will still exist. So playing a turnaround. They yield 6+%. Question: what is your opinion of Dow and LyondellBasell? Well, let's have a look. Yeah, these are. I mean, I don't think anybody watching would be surprised to learn that this one doesn't really interest me, for all the reasons that I previously expressed, which is it's the cigar butt strategy. The Pfizer thing, a little bit different. They at least have really good free cash flow and steady and growing. Not so here. This one wouldn't be one that I would personally be interested in. So we'll start with that. And now let's take a look at Lyondell. So this one's a little better. It's got a lot of debt, I mean, it does at least have some earnings and some anticipated earnings growth. It hasn't had negative free cash. That's the other thing, is that I always worry about these companies that, like Dow, that have had, everybody's optimistic that, they're going to turn the corner, it's going to become cash flow positive, and they've had these big years of negative free cash flow, no earnings growth, or no earnings, or even losses. This is not particularly exciting, but it is not particularly expensive either. I guess you're probably getting the feeling that I'm not that crazy about this one either. I don't know how else to say it. I'm just, again, look, I think you want to invest in. It's just hard for me to get excited about companies that aren't growing. As if you're going to go out and stock pick, there's so many companies out there, and you're going to generally be long the S&P. So why are you buying other companies? You're typically buying them because you think they might outperform, and you're willing to do that in conjunction with your broader market exposure because you have a diversified portfolio anyway. So you pick good companies that you expect are going to grow, that are generating free cash flow, that might be at least have some immunity to the vagaries of the economy from one period to the next. Again, this. Yeah, so I'd be curious to know what you think is going to be the big reason to get behind this one. And that's, this is one of the struggles, right? I will just say this, and I have done this, right? So I have absolutely, in many years ago, I would screen, just regularly screen. And what would I screen for? I would screen for cheap companies. I would look for companies that I thought were just beaten to death, that had low PEs, and the idea being that there was a backstop on valuation. And maybe there was. But that doesn't make it such a great, you don't get outperformance from those typically. At least that has been my finding. And let's do something here to kind of illustrate this. So here's Pfizer. This company has been cheap for a long time. It had this huge rally. Now we're looking back 10 years. And you had a positive rate of return, net of dividends. If you had bought the stock and simply put the dividends into the risk-free rate or something like that, over the course of that time, you'd have 48% gain. And you can see that if you had bought it on the lows, it kind of trundled along the lows. And maybe that seems attractive. But this is net of dividends, right? That works out to 4% annualized. 4% annualized over the course of a decade. I don't know. Oh, DJ. Yeah, so you used to like BJ. Yeah, so this is okay. So, nice. So you must obviously have been watching a few of these. So BJ's Wholesale, this is a slightly different situation. Why did I like BJ's Wholesale? Because it exhibited all of the things that I was talking about. It was trading cheaper than its comps. And on top of all of that, it was, now I'm trying to remember, maybe Jay or somebody can find out when it was that I had mentioned this thing. Was that a year ago that I brought this up on the channel? I don't remember exactly when it was that I brought it up. I was just told. November 18th, 2024. So I wasn't that far off. So back then, I mentioned that I liked the stock. And as we can see, it turned out pretty well. Why did I like the stock at the time? Because I could get a growing company in a stable business. They were kind of doing what Costco does, way cheaper than Costco, and I was buying it cheaper than the market overall. Now, admittedly, haven't had a position in this thing recently. One of the reasons was because it narrowed that gap quite considerably. We had a situation where back at that point, it was 85.70. What do we got? We got 40% out of it in what was this? Okay, so this was between, so 40% returns and, just under 100 trading days. The multiple wasn't quite as compelling anymore. And so it no longer exhibited that characteristic that I really liked, which is looked like as good or better growth than the S&P at a cheaper multiple. Just growth at a reasonable price. But now, actually, it's interesting you bring it up because we're almost right back to where we recommended it the first time. So now we have to take a peek and say, okay, well, do we still feel the same way about the growth prospects? And so right now we're looking at decent numbers for next year. Remember, their fiscal year is jogged by a month, so 2027 is really calendar 2026. $90 at 470, 19 times. I'm not crazy about this. Why is free cash flow forecast to drop year on year? That deserves a little bit more investigation. But yes, we're getting back to a level, sub 20. So again, this just goes to what we're talking about. It's kind of a staples company. Staples, by the way, if you guys were following retail yesterday, you're going to see that a lot of discretionaries were down on the back of the government shutdown stuff, on the consumer debt data stuff. And what was up? Staples were up. the names like Walmart and so on. These kinds of companies are doing well. So the short version is, yeah, this is beginning to look compelling once again. I need to dig into this number a little bit more before I answer, because as you might expect, when I talked about BJ's a year ago, I had been looking at it a lot. And then once it was off the sheets, I just sort of stopped paying very close attention to it. But good on you for keeping track. And actually, I will tell you, it's not a habit that I enjoy, but it is one that one of the best investors I've ever known does do. And that is that all of the companies he's familiar with, he keeps them on a couple of screens and just monitors them all the time. And so you have done that, and I appreciate you bringing this one back to my attention, because I think this one may indeed be getting interesting again. So this is not just somebody playing along at home. It's somebody paying attention at home and bringing something back to my attention, which I most wholeheartedly appreciate. And with that, I have squandered, hopefully I haven't squandered it, I've chewed up a full hour of your time. As always, I really appreciate that you guys tune in for this stuff. And I also appreciate your questions and your comments and reminders that there are companies that I was thinking about a year ago that I should probably start thinking about again. So like, subscribe, notification bell. Sorry I didn't get to your questions, comments, and hopefully we'll be able to address those on the next one. I'll see you then.